Hello students, welcome to Mr. TK classes. In this class, we are going to cover statement of cash flows. So we are going to do question 3 from FAC2602 September or November 2021 UNISA question paper. The question reads, you have been presented with information relating to Ivan Limited. Ivan Limited manufactures furniture in South Africa. Ivan Limited has a financial year end of 31 December 2019. Below are extracts from Ivan Limited's financial records. Statement of financial position as at 31 December 2019. So we have 2019 and 2018. Statement of profit or loss and other comprehensive income for the year ended 31 December 2019. So we have 2019 and 2018. Additional information required. Prepare the following sections of the statement of cash flows of Ivan Limited according to the direct method for the year ended 31 December 2019 after adjusting for all entries mentioned above. A. Cash flows from operating activities. B. Cash flows from investing activities. Please note, your answer must comply with the requirements of International Financial Reporting Standards. Round off all amounts to the nearest rand. Show all calculations. No comparative figures are required. The notes to the statement of cash flows are not required. So, this is the layout of statement of cash flows in accordance to the direct method. So we are going to prepare the whole statement of cash flows. Yes, we are required to prepare these sections only, but we are going to prepare the whole statement of cash flows. Okay, so let me just give you an overview of statement of cash flows. We are going to have that here. All right, so I'm going to say overview. Right, so under operating activities, right, we will have current assets, and we'll look at current assets and current liabilities. Right, that's what we'll be looking at. Then under investing activities, we'll look at non-current assets. Under financing activities, financing activities, right, we'll look at equity as well as non-current liabilities. Right, okay, so yes, we'll also look at our statement of profit or loss and other comprehensive income as well as additional information. Right, okay, all right, so we are going to start by calculating cash receipts from customers. Right, so we're going to use trade and other receivables account. Okay, so trade and other receivables account is an asset account. Right, so since it is an asset account, it has a debit balance, which means it increases on the debit side and decreases on the credit side. Right, okay, so our financial year is 2019. Our financial year ends 31 December 2019, which means that these are opening balances. Right, closing balances for the year ending 31 December 2018 will be opening balances for our current year. So these are our opening balances and these are our closing balances, right? So balance brought down 980,000, right? Then balance carried down, balance carried down, balance carried down 1,050,000, right? This account is increased by sales, so these are our sales. So we take sales for the current year. This is balance at the beginning, sales for the current year, balance at the end. Okay, sales. Then our total 980,000 plus 5,800,000, 6,780,000. Okay, let us take that amount and bring it here, right? Subtract 1,050,000, 5,730,000, right? 5,730,000. Okay, so this is cash receipts from customers. Cash receipts from customers, right? So this amount will be recorded on the debit side of our bank account, right? Will be recorded on the debit side of our bank account. All right, so we move on to the next line item, cash paid to suppliers and employees. Cash paid to suppliers and employees. All right, so we are going to use this ledger account, and our balance brought down 450,000, right? Because for us to have trade and other payables, it means we are actually owing our suppliers. So this is what we were owing our suppliers at the beginning of the year, and this is what we're owing our suppliers at the end of the year. But before we do that, there is an adjustment here that we need to look at, right? The following items are included in trade and other payables. All right, what are those items? Dividends payable, tax payable, right? Let me scroll back. You can see dividends paid here, taxation paid here. So it means these two items, right, should be shown separately on the face of statement of cash flows, which means that they are not going to be part of cash paid to suppliers and employees. Those two items should be shown separately here. So what we are going to do, we have to adjust our balances. I remember we had 450,000 here, right? Let's just make sure. Okay, 450,000. Then at the end, 755,000. Okay, let's scroll down. So we are going to say we need to subtract this 45,000, right? We need to subtract 80,000, right? Okay, then here we need to subtract 30,000. We need to subtract 30. Okay, then let us calculate. Okay, 450,000 subtract 45,000 subtract 80,000, 325,000. Right, then here 755,000 subtract 30,000 subtract 30,000, 695,000. Right, so this account is increased by our expenses. Right, we can see that we have cost of sales, $2,320,000. Right, we have other expenses, 500,000. Right, other expenses, 500,000. Okay, then finance cost is shown separately on the statement of cash flows. Right, we can see that we have interest paid here. Income tax is shown separately. Right, revaluation, we'll look at it when we are looking at non-current assets. Okay, right, so do we have any other information in regards to these expenses? Yes, I can see we have the following items amongst others are included in other expenses. What are those items? We have depreciation. So what we are going to do, depreciation is a non-cash item. It should not be part of our statement of cash flows. Right, so we want to remove it from this amount, so we are going to debit it. Let's debit depreciation. Right, and how much is that? 245,000. Let's debit impairment of financial assets, right, 20,000. Okay, then what else? Okay, let me just scroll down. I'm going to explain here. All right, overview. Yeah, I can just take the overview down. Right, okay, and cost of sales. Right, so this is our cost of sales calculation. Right, this is our cost, because we can see that we have cost of sales here. But we need to know how do we calculate this amount, cost of sales. So let me come here. We calculate it this way. Opening inventory, right? I can see we are given that amount. But for now, we are going to ignore these amounts. Closing inventory, sorry, we are going to add purchases. Right, then we subtract closing inventory. Okay, so this is how we calculate our cost of sales. Cost of sales will be this amount right here. Okay, so we can see that everything else is there. Opening inventory, closing inventory, cost of sales. But what we don't have is purchases. Right, and that's what we want to calculate in this account. In this account, we we want to calculate purchases, there should be entries that will calculate purchases amongst other entries. So we have calculation of purchases in this account. So how do we do that? It means we are doing it by way of bottom up. We are starting from the bottom going up. So since we are changing the direction, it means the signs will have to change. So cost of sales plus closing inventory, we are adding this because we are changing the sign, we changed the direction. Subtract opening inventory is equals to purchases, right? Is equals to purchases. So we need to do this calculation inside that ledger account, which means that we are adding closing inventory, we are subtracting opening inventory. So cost of sales is this side. If we want to add closing inventory to it, we should post closing inventory that side. So our closing inventory 1,100,000, right? So it means opening inventory should come this side. Opening inventory. How much is that? 950,000. So in this account, there are entries which are calculating purchases amongst other entries, right? So at the end of the day, we'll be able to calculate our bank amount, which is cash paid to suppliers and employees, right? Okay, 4,245,000. All right, let's bring this here. Then subtract 695,000, subtract 20,000, subtract 245,000, subtract 950,000. 2,335,000 bank. This amount will be on the credit side of our bank account, right? Okay, so let us take it. This is cash paid to suppliers and employees, right? So before writing this final amount, let us just check that, because we have already written this amount here, but we need to check something, because I can see we have other income of 300,000, right? Let us see what other income consists of. Let us see what other income consists of. Other income consists of interest income. Interest income is shown separately as interest received on the statement, on the face of our statement of cash flows. Dividends income, we also have dividends received here separately. Profit on sale of asset, this is a non-cash item, right? This is a non-cash item, right? Other income consists of these things. So we are not going to change this amount, it's going to remain like that. Okay, then let us calculate cash generated from operations. 5,730,000 subtract 2,335,000, right? 3,395,000, right? Cash generated from operations. Then let us calculate dividends paid. Let us calculate dividends paid. So what we are going to do, okay, all right, I just wanted to add something there, but let us look at the information that we are given first. We can see that dividends payable, we have this and this. All right, you can see here on number 4, the dividend paid for the current financial year amounts to 230,000. So they gave us that amount, 230,000. And then, and the taxation paid amounts to, so they gave us that amount as well. Taxation paid 939,840. Right? So there's something that you need to take serious note of when preparing statement of cash flows. Every time you say paid, you should put that amount in parentheses, right? You should put that amount in parentheses because that is cash that is going out, right? Every time you say received, that amount shouldn't be in parentheses, right? Okay. Then what else? I'm not seeing any additional information in regards to interest, but I can see we have finance cost of 102,000. So it means at the end of the year and also at the beginning of the year, there was no outstanding interest, and also interest was not paid in advance at the beginning of the year and was not paid in advance at the end of the year. So that amount that we have is what was paid because nothing was outstanding. Okay, then interest received, we need to come here and check the breakdown of other income. You can see that other income consists of interest income, and also interest income was not outstanding at the end of the year and also at the beginning of the year. We didn't see anything like that here, right? And it was not received in advance at the beginning of the year and also at the end of the year, which means that we received 121,000, right? We received 121,000. Then what else? Dividends income 80,000, right? We can see that no dividends income was outstanding at the beginning of the year and also at the end of the year, which means that we received 80,000. Dividends received 80,000, right? So interest received 121,000, dividends received 80,000. Okay, then I can see that we have financial assets, but we need to check, we need to know the story behind our financial assets, right? Because remember, financial assets can fall under non-current assets and can also fall under current assets. So if our financial assets are falling under current assets, it means we have to address them under operating activities. But if they are falling under non-current assets, we have to address them under investing activities, right? So let us see. The company's financial assets are held for trading, which means that they are current assets, right? They are held for trading, which means that they are current assets with the intention of making, with the intention of short-term profit taking, right? Okay, so this is a current asset. This is a current asset, so we are going to address it. We should address it under operating activities, right? So now we need to calculate and see if we received money or we paid in regards to this financial assets, right? Financial assets at fair value through profit or loss. Even this, you can see that they are under current assets. So this was very clear, and they also wrote here through profit or loss, which means that they are under current assets. So everything was very clear there. Okay, then balance brought down 450,000, balance credit down 500,000, and I remember there was impairment loss, right? The following items amongst others are included in other expenses. So this is under other expenses, which means that it is an expense. So this is impairment loss, right? 20,000. So we are going to get 520,000. We are going to get 520,000, right? Then 520 subtract 450, right? 520,000 subtract 450,000, 70,000, right? Okay, bank. So this amount will be on the credit side of our bank account. This is amount paid on acquisition of financial assets. So 70,000 was paid to acquire financial assets. Right? Okay. All right. So we are going to say this, right? Subtract this. Subtract this. Okay. Subtract this plus, right, plus minus. Okay, so this is our answer, 2,254,160. So since this amount is not in parentheses or is not in brackets, we are going to call it net cash from operating activities. If it was in brackets, if it was a negative, we're going to say net cash used in operating activities. Okay, then let's move on to investing activities. So we said investing activities, we'll be looking at our non-current assets. All right, so before we do that, let's just check if we addressed all our current assets and all our current liabilities. Yes, inventory addressed, trade and other receivables addressed, cash and cash equivalents not addressed. The reason being, we'll address it here, right? We'll address it here at the bottom. Financial assets addressed, trade and other payables, fine. Okay, then all right, these are our non-current assets. We just have one thing there, property, plant and equipment. Let's see, there might be a breakdown of that. Yes. Okay, property, plant and equipment consists of the following. We have land and buildings, right? We have equipment and machinery. Okay, it is the policy of the company to revalue land every 2 years. At the end of the current financial year, the land was revalued. That's why we can see this revaluation here, 160,000 revaluation surplus, right? Okay. Any other movement in land and buildings during the year was to expand the company's operations. Okay, so under cash flow from investing activities, we have two subheadings. We have investment to maintain production capacity. We have investment to expand operating capacity. So they said any other change there will come here, investment to expand. So let us prepare land and buildings account at cost, right? Okay, so We know that land does not depreciate in this module. Land that depreciates is land for quarry and mines, but we are not doing that in this module. So just know that land does not depreciate. And the information that they gave us, they gave us land along with buildings. They didn't separate these two, right? Then they did not give us any other information about buildings depreciating and stuff. So we are going to know that land and buildings in this question do not depreciate. So carrying amount will be equal to cost because there is no depreciation, right? So this is our cost at the beginning, this is our cost at the end. So cost at the beginning 2 million, cost at the end 5,050,000, right? Then we already know one thing here, revaluation. Our land and buildings increased by 160,000, right? Any other change is due to expansion of operating capacity. So this is our total. This is our total. Okay, we can see that there is something here. Okay, 5,050,000 subtract 160,000 subtract 2 million, right? 2,890,000. 2,890,000. Then we take this amount, right? This amount will be on the credit side of our bank account, right? We will be on the credit side of our bank account. So let us take that, right? This is what was paid, right? So we are going to say additions to property. Additions to property. Okay, then do we still have anything else? Yes, we have equipment and machinery, and we need to know what happened to that. At the okay, in the previous financial year, management erroneously purchased a machine that did not meet the requirements to manufacture the specialized products of Ivan Limited. For this reason, the machine was sold in the current financial year, which means that we have proceeds on disposal, right? And the profit on the sale is included in other income. Management replaced this machine with a new machine that is more suitable for production at a cost of 2,300,000. Okay, let's prepare that account at carrying amount. It's faster that way, right? Okay, so we know that this is our line item that is giving us depreciation because this one does not have depreciation, right? Okay, so these are our carrying amounts. These are our carrying amounts. Why am I saying that? Remember, they recorded this as property, plant and equipment in the statement of financial position. We know that in the statement of financial position we record the carrying amounts. So these are carrying amounts. So there we have 1,550,000, then 3 million. Okay, then additions. So I'm going to say bank. Okay, 2,300,000. 2,300,000. 2,300,000. So we are going to take this to our statement of cash flows, right? Okay, let us take this to our statement of cash flows. Let's take this to our statement of cash flows, right? Replacement of, what were they replacing? Right, replacement of machinery. Okay, replacement of machinery. replacement of machinery. So this was paid to buy a new machinery to replace the other machinery, right? So if it's replacement of something that was there, it means that it's investment to maintain production capacity, because remember, you are replacing a machinery that was there, so you are maintaining production capacity, right? So this is different to the purchase of land and buildings. We were not replacing any land and buildings. This was to expand operating capacity, right? Okay, then we are not yet done with that account. Let's go back. Okay, we need to calculate disposals, or just disposal at carrying amount. This is what you need to calculate, right? But because this account is at carrying amount, we should also decrease this account with our amount of depreciation, which is 245,000, right? This account is at carrying amount. You know that carrying amount means cost subtract accumulated depreciation. So we should credit depreciation in that account, right? So we are only left with this. So let's calculate. Let's calculate 1,550,000 plus 2,300,000. Okay, right? Then let us copy our amount, 3,850,000. all right. Okay, then subtract 3 million, right? Subtract 245,000, 605,000. So this is the carrying amount of the asset that was sold, right? Was it sold at carrying amount? No, because they are talking about profit on sale. It was sold at a profit. So this is the carrying amount, 605,000, and it was sold at a profit. It was sold at a profit of how much? Profit on sale of asset, 99,000. It was sold at a profit of 99,000. So this is amount received on sale of that asset, 605,000 plus 99,000. So 704,000 was received, right? So this is proceeds on disposal of equipment, right? Equipment and machinery. Okay, right? So this is proceeds on sale of machinery, 704,000, right? Proceeds on sale of machinery. Proceeds on sale of machinery. Proceeds from sale of machinery. Proceeds from sale of machinery. Then we are done with our non-current assets. Okay, we just want our totals here. Not difficult to calculate because we just have one amount, right? 2,890,000. Okay, minus 2,300,000. okay, right? Minus 2,890,000 plus 704,000. Okay, we are getting a negative 4,486,000, right? Because this is a negative, it is going to be net cash used in investing activities. If it was a positive, we're going to say net cash from investing activities, right? So let us move on to financing activities. Financing activities, we are looking at equity and non-current liabilities. Let us do that. Equity, and I didn't see any adjustment in regards to equity, any adjustment in regards to non-current liabilities, which makes our life very easy, right? Equity changed from, right, okay, let me just write, equity changed from 300,000 to 700,000, right, which means that there was issue of shares there. So we are going to say proceeds from issue of shares, right? 700,000 subtract 300,000. The answer is 400,000, right? Okay. Then long-term borrowings, you can see that this line item increased, right? Which means that the company obtained a loan, right? The company obtained a loan, so there are also proceeds there. Proceeds from long-term borrowings, right? So how much was received? 2,355,840 subtract 124,000. Okay. 2,355,840 subtract 124,000. 2,231,840, right? Okay. Then net cash from financing activities. Oh, I shouldn't have removed that. Okay, but it's fine. 2,231,840. Okay, 2,631,840. Right. Okay. Let's calculate our net increase or decrease. Right. So it depends. If it's in parentheses, net decrease. If it's not, net increase. 2,254,160 subtract 4,486,000, right? Plus 2,631,840, 400,000. 400,000. Then opening cash and cash equivalents, 300,000. Do we have any bank overdraft? No. So 300,000. 400,000 plus 300,000, 700,000, right? So we have 700,000 here, and we have 700,000 here as our closing, right? This is our closing, 700,000, 700,000. Okay, so this is how we prepare our statement of cash flows in accordance to the direct method. Thank you so much. I'm out.